Eric will
What's going on, guys? Woods here. I want to bring forth an order block lesson here. We talked about demand in the last lesson video, so I want to jump right into this one. This bounces off nicely off of that last demand lesson. I had an overwhelming amount of people ask for this one compared to support and resistance, so I decided to do this one. What I'm going to do is I'm going to bring up this APT chart, and I'm going to bring it back to around right here, just because I like the reactions that happen around here. And I think, like I said, it bounces off and ties in nicely with the demand zones. So from the last one, for people that did not see my demand lesson, I'm gonna explain really quickly how a demand is made. And then I'm gonna explain what the order block means to me and how I would play it. So you get an impulse to move up, a little bit of resistance to push the price down. People willing to enter APT right here, which pushes the price up, breaking the highs, creating the demand zone. You would then bring out your rectangle and place your bids within the rectangle. Price comes down, holds the demand level, and bounces. All right, there's a picture perfect demand level. And then I would draw a rectangle around this one up here. And you can see this demand zone hasn't been touched. The moment it does, you get a reaction out of it. Bam. So demand zones and order blocks, in the way that I see them, they counteract nicely together. But the way you're going to play an order block in a demand zone is completely different, right? A fresh level of demand, you're going to place orders in, you're going to place your bids, wait for the level to test, wait for your orders to get filled, and then wait for a reaction. Either it's going to play out or it's not. Order blocks, you're going to have to wait for that demand zone to become invalidated. What does that mean? When price slices through this demand zone that was previously valid, you got to bounce off of it, and then it slices through, this is invalidating your demand zone. Doesn't mean that you're going to just throw away your demand level. You're going to then utilize your demand zone as an order block. So now you're going to use it as a point of reference. What does that mean? When price slices through the demand zone, deviates under, comes back up to retest it, it's then a level that people are looking at. So this is going to be a level that you can make a decision based off of confluence that you used. The higher the time frame, the higher the probability in the play, or higher conviction you can have in it. Obviously, you can use it on the 5-minute, 15-minute, 30-minute, 1 hour, 4 hour, 1 day. That's all up to you, and you're going to evaluate your risk for the play. But when price slices through this demand zone, it's going to come back into it, and then you're going to make a plan off of that. So you can see price comes into that demand zone that it rejected off of, and it's putting in a bearish retest of the level. So this would be a good point of reference for you to short. If you think it's going to flip and you think momentum is on your side, or it's going to reverse and continue upwards, you're going to look to take a long around this level based off of your confluences, right? Order blocks, it's not a right or wrong type of thing. So it's not like because price sliced through, came up above, it's going to put in a bearish retest and ultimately reject. That's not how it works. It can still flip this level up, but the way that you see momentum here and the way that it breaks down and rejects through, it could be a good level to short. And this is how you're going to play it. And you see price is going to come in and reject off of it. So again, a previous level of demand, you got a good reaction at first, and then it rejects. It's going to be a nice point of reference for you for when price comes into the order block again, for you to then play it, right? So now we got that one rejection off of. It then comes in to test our previous demand zone. Now, price is going to come back into the order block, take out the highs from the first bearish retest, sweep these highs right here, and close below. So the best way that I found to validate an order block and to put your invalidations in the right place is to use a manual stop. As long as you keep getting closures within that block, depending on the play you're trying to take. So let's say, you're looking for, let's say, a long over here, and you keep getting closures above when you're trying to push in, it can still be a valid long. When price comes up to the top of the OB and it closes below it, it's a good sign to still short it, right? It's not breaking through. It's not giving you a clear invalidation. You could have your invalidation slightly below this wick and get taken out if you were to use a hard stop. So it's always safer to use manual stops, especially when you know the level you're playing around. And that's really how I would play it. And you can see right here, it's going to reject out this order block right here. And you had your point of reference. So let's say you're not in a short from the top wick, right? And you want to get into a short. You have your point of reference. You know where we're trading around, and you know how you're going to play it. And then you get a rejection out of this order block right here. Now, what I want to do is I want to see the reaction that comes forth this bottom zone, because I know APT is going to reject down. I know it's not going to give a retest at this level again from up here. So you got two good shorts right here, 1, 2. Now price is going to come into this demand zone, which is still valid. Obviously, it's not as strong as it once was, right? The more times demand is tested, the least likely it is to hold. And you can see that when price comes into the order block, which is still a demand block, it's going to look to flip it downwards. And you can evaluate a good short from this reaction just based off of your intuition of saying, okay, the demand zone was retested a few different times. We had a few good reactions from it, and now it's looking to flip it down. Obviously, utilizing and tying in other confluences work great. We got a break of structure, right? We got supply printing right here. So these are good confluences for you to add on to the bias of getting short, right? And you can play the order block like that, right? And now we slice through the demand zone. So now you treat this as an order block, just like you would up here. And again, price comes up, deviates to the top, comes back into the order block, closes below. You can use this as another good point of reference to short. You're using these order blocks as a good point of reference. That's the whole point of these order blocks, is that you're not blind to when price comes to a specific level. So there's order blocks that print on the chart all the time. There's levels of demand that get sliced all the time. Like I could point out this one right here. You see how we created this level of demand. Price came into the level of demand. It was holding it until it sliced through, came back into it, rejected. Right? This is a perfect example of what we're explaining today. And then again, came down into the previous level of demand, sliced through, came up. Where did it retest? Put in a lower high within the same order block. Or it's important to have a directional bias when you're playing these order blocks. So you have to assume where you think the market's going to go to take that position, right? That's why I call it a good point of reference, because it's a point of the chart that you're referring back to. So you know how you're going to play it. You just got to evaluate it based off of your confluences, right? If you think market's going to go down and we're trading within this order block right here, you're going to look to take a short. If you think the market's going to go up, then you're going to look to take a long within that order block. Now price is deviating below this order block. Now it's not a level of demand. Now it's an order block. So what would I do? I would put an alert at the bottom end of this order block. And when price comes into the order block, I then know to look for a long or short based off what I think the market's going to do. If we begin to flip the bottom end of the OB, I'm going to look to take a long, and I'm going to look to TP at around this level. The beauty of it is it's a little bit of a loose demand zone previous. So there's a good enough area for APT to run if we begin to flip this level, right? You're looking for a good, about a 10% move up. And then anything above that is just extra. And again, the beauty of these order blocks is you don't necessarily have to catch the bottom, right? If you're not in a long from the low, if you're not in a long from, let's say the break over here, you know, you can look to get long when price begins to trade within that OB. And it's good because other people are looking at that level as well. So this proves that other people are willing to play this previous demand zone, right? There's liquidity that is going to be played within this level. And you want to use your confluences with this, right? You don't want to just have an order block and say, all right, I'm taking a long once it comes in this. No, you're going to utilize your confluences and have a directional bias on where you see the price to go. And now price is going to look to flip. It deviates a little bit under, and then it flips the order block upwards. Retesting this OB, wicks are slicing, closes below the OB. So now you're going to look for a reaction to get short around here. And then it rejects. So you can use hard stops. There's nothing wrong with that. It's just all about your risk management, right? As long as your risk is managed, you play the order blocks however you see fit. And then we end up flipping the middle end of this OB right here. Again, retesting the same order block, of which we close below. So you get another good reaction to go short. All right. And obviously all this is hindsight, right? Obviously it's all hindsight, but this is for the sake of the example, right? So you have a directional bias. You have your levels that you understand, your good point of reference. And then you tie in whatever confluence that you deem necessary to take that play long or short, debating on where you assume price to go. All right. All right, guys. So I just wanted to click on a random chart as well. Like I said, you can play this on the hourly, you can play this on the 4 hour, and I'm just going to seek specific order blocks. And I'm going to show you how they would have played out, right? So let's see. We got FET here. I haven't really looked at this chart and just kind of looking at it for the first time now. And I just want to evaluate a good order block, right, to play on the 4 hour. So obviously we got this. All right, beautiful. I mean, we got this one right here. So we got this level of demand. Slice through. So it's invalidated completely. Comes up, almost retested right here. Comes down, and then comes up into it. So when FET comes into this level, you can look at it as a good point of reference to get short. And look how beautifully this wick retests this level, this previous level of demand that sliced through, and now you treat it as an order block. Absolutely picture perfect. Example right there. And what I want to do again is I want to look at the hourly and seek something for you guys there as well. Bam, right here. Just most recent example of a good level of demand that got sliced through, and now it's treating as an OB. It's just picture perfect, guys. Picture perfect. All around the chart, all day, every day they're printing. And you just play them as a point of reference. You got to have a directional bias though, right? You got to utilize your confluences, and you got to assume where price is going to go, and you got to have a clear invalidation. Usually, like I said, a manual stop loss is good. It's okay to use hard stops depending on your risk management. As long as your risk is managed, you're good. And with this OB right here, we had demand. It moved in, sliced under, impulsed out. So you got a good reaction initially off the demand. It then sliced through. You're not generally looking to take a position within this hourly demand zone anyway. So you're just evaluating price. It rejects, deviates, comes up, puts in a bearish retest. You're looking to short that in confluence with the supply. Just a picture perfect example of how to play an order block. Any questions, let me know in the comments, guys. Make sure to like, share, and subscribe. Follow me on Twitter. If you want to trade with me on Bybit or BitGet, my links are going to be in the description below. See you in the next video, guys. Peace.